Well, good morning or good afternoon, everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted to be joining you this morning. This was a class I designed and taught for many, many years, and it still has a very special spot in my heart. Today, we're going to talk about a strategy called a buy right covered call. So this is a strategy that some people will use to generate income. This is a strategy that some traders might use to grow their account. And this is, I feel, one of the kind of more intuitive strategies, that if you're new to the world of investing and new to the world of options, I think it's an easier strategy to wrap your head around. Now, having said that, I thought it was the craziest strategy I'd ever heard of when I first heard about it. Thought, why? Because with this strategy, we're buying a stock and then selling a covered call. And I thought, if you're bullish on a stock, why would you buy the stock and sell a covered call, which could limit your gains at the same time? So we're going to talk about, why that is and all those good things around it. If you are brand new to the world of options, you are in exactly the right place because this is a getting started class. So if you're here for the very first time, feel free to type a greeting into the chat. And because we'd like to welcome you to this community. And if you are one of, as I affectionately call them, the usual suspects, thank you for being here. I'm delighted that you are joining us today as well. I have Connie Hill with us in the chat. She's a friend and fellow coach. And I invite you on behalf of Connie and I to follow us in the land of X. My handle, Barbara Armstrong CS. Connie's is Connie Hill CS. And I'm already seeing lots of questions in the chat. So feel free to quest away, and between Connie and I, hopefully we've got answers for you. If you're watching this in the archives, you too have a voice. And if you've got questions, just type them in. I do look at those on a daily basis. Okay, just before we get into the thick of things today, know that options carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements in order to trade options with Schwab, and not all will qualify. We are looking at a covered call strategy today, which provides downside protection only to a certain extent, to the extent of the premium received. And it also can limit your upside potential. We'll talk about why, in spite of that, this might still be an appealing strategy. And while we are looking at technical analysis in this class, other approaches, including fundamental analysis, being aware of what's going on globally in the market within our own country, all of these things are important as well. We use the Thinkorswim Paper Money platform on the Thinkorswim desktop platform for our examples. And with Paper Money, we're using the Paper Money software application, which is a brilliant place to learn. It looks like, smells like, feels like real money, but it's not. One of the differences is that a covered call that we have sold will never be called out early in Paper Money. That could happen in a live account. Okay. Also, if we're using stop loss orders, it's not a guarantee that, we'll get out when at the exact price that we have asked. If the stock were to gap down, we could be out at a much lower price. So hot sauce, I see your questions, and just give me a minute, and Connie will post a link to the playlist for this class, but I will show you how to find some intro classes. So our agenda today, we're going to look at what a buy right covered call is, and then we're going to identify when we might want to use this strategy, what expiration date we might want to choose, what strike price we might want to use. And if these are all new terms, I do my very best to speak in English, but know that there is a language around the world of trading. Okay. And then we're going to discuss how to manage these trades. And one of the reasons I chose this strategy today is because I have two example trades in a Paper Money account that will expire this Friday. And so it's a chance to both look at a new example trade, and then we'll look at how we might manage trades as well. So what exactly is a buy right covered call? And actually, Michelle was asking about intro classes. So let me just pause for a second. First of all, there is a subscribe button in the bottom right-hand corner of your screen. And if you click on that subscribe button, it will give you access to Trader Talks from Schwab Coaching on YouTube. And it's a free resource that you have access to. There's no charge to join. And when you first get there, the home screen, it'll show you this whatever is currently being taught, which is currently getting started with options. Okay. Now, if you click on playlists and then scroll down closer to the bottom, for some reason, the getting started classes are listed down here. So here's a getting started with Thinkorswim class that's taught on Wednesdays. Getting started with technical analysis is understanding how to look at charts. And that's being taught today at 2:00 Eastern. So, and that I teach now in a rotation as well. So, we're now on week 8, actually lesson 9, which, we're getting close to the end of the series, but you can join at any time. And so when we're out looking at charts today, if charts are new to you, it's important to understand how stocks move so that you can understand if you're interested in using options. These kind of go together like peanut butter and jelly. So there's a getting started with charting or technical analysis series. And then there's also this getting started with options series. So let's click on that. So here's the whole playlist. Last week, Connie taught this. It's now being taught by Cameron May. But if we scroll right to the bottom, we can see I taught this in about a 12-week rotation. So here's the basics. So if you scroll down, here's the basics. Start here, 1 of 12. And then over a course of 12 weeks, we cover 10 or 11 different trading strategies. Okay, so covered calls was week 4 in the old review, and then this buy right covered calls, a new twist on an old strategy, week 5. So instead of binging Netflix, you could be binging, learning about options or learning about charting. There's also a new class on getting started with investing on Mondays. And so if you want to see when things are being taught, so that's that thing you can subscribe to. Then if you come to schwabcoaching.com, and I'll put a link into that as well. So for all of you that are new, here are our live webcasts and virtual workshops. So we teach over 30 classes each and every week. And so here's Tuesday, getting started with options. James Boyd just taught a class, the Investor Master Series, which is more of an intermediate level class. Next up will be long options and then getting started with technical analysis. And, I've just clicked on the first one for the month, but here we are on the 17th. And then there's a class on swing trading and then one on selecting an option strategy. Now, let's say that you watch this class and you think, gee, I really connect well with Barb. What other classes does she teach? If you can choose by coach. If you're brand new to all of this, you can choose by skill level. So you could say, I don't care who the coach is. I just want to see all the beginner classes. So here's a stock investing for beginners. I just talked about that. Okay. So if you're looking for resources, these are the 2 places to start. So for Michelle and the hot sauce, and the rest of you, because if one of you asks this question, there are probably dozens of you out there thinking the same thing. Okay. So back to our regular programming now. But keep firing those questions in, guys. So here's our buy right covered call. So what is this strategy? So it's a strategy where a trader buys a stock and then and 100 shares of that stock at least, and then at the same time sells a covered call. So why would we do that? Because, I thought, that this was kind of a really silly idea. But, and then someone said to me, well, because you could potentially earn a return of maybe 2 to 6 or 8 or sometimes 10% in 30 to 50 days. And I went, okay, tell me more. And so I'm going to tell you the more. So selling the call, when we sell the call, what does it even mean when I sell a call? Well, when I sell a call, I am obligating myself. I am agreeing to sell the stock at that price at any time between now and expiration. And it's similar to, we call it writing or selling a call on a position we already have. So we already have 100 shares of something and we want to sell a covered call. We call that legging in. So the difference is the timing. Now, I didn't do this. This isn't a boo-boo on my part. Sorry, just a sec. Let me bring up my drawing tool here. And let me just pull it off the screen. So here's the idea. We have a stock that's been going up. I guess it would be better if you could see it. So let's say the stock has been going up, and stocks don't tend to go up in a straight line. But and then it pulls back a little bit, and then it looks like it's going to go up again. Or, and so we might say, you know what, I think this is going to continue going up. So I am going to, and let's say it's here at $48 currently. And let's say I think it's going to continue to go up. So I am going to sell a call at $50. And what I'm hoping is that, or what my expectation is. I say hope is a 4-letter word in the world of trading. But my expectation is that this uptrend is going to continue and then it's going to go up through my strike. And if I sell this call, well, when you sell something, what happens? I get paid. So let's say I get paid $1.50 a share for that. And I buy the shares at 48. So what's the most I can make if I get called out at 50? Well, if I'm called out, the most I'm going to make is $50 a share, but that's $2 from where it's currently trading. Plus I got paid $1.50 a share. Sorry, so I made $3.50 on an investment. My stock cost 48. So if I say $3.50 divided by 48, what's that potential return on my risk? $3.50 divided by 48, it's 7.3%. And typically our goal is to be in this for somewhere in the range of 20 to 50 days. That's the expiration date we're looking for. So you might say, well, geez, if I could make a 7.3% return in that kind of time frame, geez, if I could make a 3% return in that kind of time frame, I might be a pretty happy camper. And if this happened right away, like let's say the next day we come in and the stock is gapped up to here and it's now trading at $53, are we going to be crying in our beer because we got called out? Now, in paper money, you wouldn't be called out, but in reality, could you be called out? No crying. There's no crying because you just made a 7.3% return. You were willing to be in this. Let's say we were going out for 30 days. And if you got called out after 5 days, we should be doing the happy dance, popping the champagne. because we now have our money back and we can go and place the next trade. The $1.50 is what I'm just making these numbers up. We receive by selling the call. Okay. And so somebody is asking a tax question and saying, for taxes, are you paying short-term gains plus ordinary income on the option gain? This would be, if you're only in this for 20 to 50 days, it's not going to be a long-term trade, but talk to your accountant about that. So somebody's asking, what do you mean being called out? So being called out, if I sell a call and the person that bought the call exercises their right to buy the shares from me at $50, it's probably slang, but we call that, you're being called out. In other words, your call has been exercised. And this can happen at any time. Okay, I'm loving all these questions. Why do we get a premium from selling? Well, if you sell a car, you're not going to sell it and sell it for free. That's called giving it away. So because I own the shares and I'm saying I'm willing to sell them, I get paid for that because I'm selling something. I'm selling the right for the buyer to buy the stock from me at this price, at $50. And we call this price the strike price. And this would be the expiration date. This would be days. We call this days to expiration. So we can go look at an example. I just want to walk you through the logic behind it. So somebody's asking the question, well, who pays this premium or this credit? The person that's buying it. If I'm selling and you're buying, yeah. So please explain the 3.5. Well, the 3.5 comes from if I bought the stock at 48 and I agree to sell it at 50 and I end up selling it at 50, I'd make $2 for the appreciation of the stock and I'd receive this credit of $1.50 for selling the option. Okay. We are not going to talk about puts today. Yeah, so Tasha's saying, can you sell your call at any price? You can choose any strike that you like. Yeah. Okay, so that's that. So I think it will be really helpful when we get out and look. So here's a few things. Okay. Here's a few things to keep in mind, and we've already talked about this. So there can be tax implications if the stock is sold. We want to consider this strategy when volatility and premiums are higher. I can sell that call for more than I often can if volatility is low. So some of the example I've chosen today is a stock that is more volatile and that means it can move quickly, both for or against you, but it also means the premiums tend to be richer. And then you want to be aware of upcoming events. So things like earnings. And if you're trading this and you want to be, conservative, and some people will say, oh, options are so risky. Well, not necessarily. There are risks and we want to make sure we understand them. And so I have an example trading plan and I'll show you where you can access that for this strategy. But one of our rules is that we don't trade this over earnings because the stock can sometimes gap up or gap down. And so that's a way of us trying to manage our volatility and risk. Okay. So, and we've already talked about this. You can be assigned or called away at any time the stock can be assigned, which means they can say, hey, you said I could buy this from you at $50 a share. It's gone up. It's now trading at 55. I'll take my 100 shares at 50. Thank you very much. And you can't go, JK, just kidding. I didn't really mean it. Like, you have legally committed yourself or obligated yourself to sell the shares at 50. And if you're called out, you are called out. Yeah. So I like this flying ponytail question. Do you get the premium regardless of whether or not they exercise the call? Yes. And in fact, if the stock doesn't go through the strike, it could expire worthless, and then you get to keep the premium. And that kind of messes with your head. Like, if you're new, because you're thinking, okay, like, just a minute, I'm selling a call. I got paid $1.50. And if it doesn't go through the strike, I would still be happy if it expired and was worth nothing. Well, yeah. Why is that? Well, because now I still own the shares. I can sell another covered call. Kind of wash, rinse, repeat. Yeah. And so, we want to be aware, like I said, of the tax implications, volatility. I'm going to show you how you can see what volatility is. Yeah, the time frame we're typically looking at is somewhere in that 20 to 50 day range. And so we're looking for stocks. And, when we're doing this strategy, actually, we're looking for stocks that are uptrending. Just one sec. I'm having trouble with my drawing tool here. So we're looking for stocks that, we're looking for stocks either that are sideways. And why might we be interested in a sideways stock? Well, if a stock was trading in a channel like this, and one of the stocks we're going to look like was doing that, and then it broke out and started to move to the upside. But if something is moving sideways, you could sell a covered call here and buy it back here. Or, for the way we're going to do this, we're looking for something that's uptrending. Okay. And we're looking for stocks that have higher trading volumes. We want the options also to have high trading volumes. So how do we define high trading volumes? Well, you can define it however you want, but for our example trading plan, we said 1 million shares per day or higher. And for options, we want at least 20 times the number of contracts we're thinking of trading. And by tight bid-ask spread, bid and ask is, what you're willing to buy and sell for, and the market maker makes the difference in between. And we don't want to pay them any more than we have to. We want that to be less than a 10% difference. Okay. Okay. Somebody said, I like your style. You remind me of my mom. Well, I am a mom. So there we go. Okay. So when it comes to strikes, and we'll talk about this when we get out there, some traders choose the first strike out of the money. What do we mean by out of the money? Well, by out of the money, we mean above where it's currently trading. So if it's trading at $48, to use my example, the first strike out of the money might be the 50 strike. Now, could you sell the 55 strike? Yeah, but you're going to receive less of a premium. And the probability of being assigned is higher the closer you are to where it's currently trading. And so with expiration dates, the further out you go, the more of a credit you'll receive, but then the longer you are in the trade. And so, if you look at that 20 to 50 day time frame, sometimes if you go out 20 days, versus 50 days, you might not get double the premium to go out double the time. So you might say, I'm going to do this for 20 days. If I get called out or assigned, I can just do it again. I can wash, rinse, repeat. And they'll position size based on two things. One, based on their maximum position size that they're allowed in their account. And two, based on if the trade goes wrong, how much would they lose? And they don't want to risk more than a certain amount. So we're going to talk about that, about both of those things. Okay. Okay, so I'm going to talk about exits. We'll come back and look at this one after. Let's go out to the platform, because I think this is where, this for me is where the magic is. So with a super micro computer, this is a tech stock. This is a year-to-date chart. And so far this year, this stock is up a 42%. Okay. So it's up 42%. It's up almost 5% just this week, up, 8.8% so far this month. But this is one of those where we had kind of a, in technical analysis parlance or chart reader parlance, we would call this a triple bottom. See, because it came back down to this bottom 3 times, once, twice, 3 times a lady, and then it broke out. And often what we'll see, we call this line here resistance, around 39. So we had this old ceiling become the new floor. And then it came down and hit this floor a couple of times. And now it's, it's kind of going a little bit sideways. But overall, this stock is having a good year. And the technology sector has really been rebounding. And so if we looked at this and said, okay, this is trading at 43.49. What if we just sold the 45? And if it keeps going sideways, what could happen? Well, if it keeps going sideways and, if a month from now and we go out about a month, it's not above 45, what would happen? Well, we'd get to keep the amount that we sold this covered call for, and we could do it again. And if it goes through our strike, let's say it goes up to 50, at expiration, we would be called out. Now, we may not want to wait until expiration. We may have, if it goes up that dramatically, we may have most of the gain we can make and decide to just close out the trade and do it again. Okay. So we can buy it back to close it out. But let's just see what kind of volatility this stock has and what kind of premiums we might get. So if we came out to the trade tab and we came out to July, which is 30 days, so that's in that 20 to 50 day window, and we looked at the 45 strike, so that's right here, we'd get 285 to 290. And you might say, well, that's not that much. Well, excuse me, I beg to differ. And why is that? Well, this is a $45 stock. Okay. So and 284, if we looked at this strike, and we're coming out 31 days, what does the 100 mean? It means it represents 100 shares. And the 31 in brackets means we're 31 days to expiration. But this call it 284, if I divide that by 45, that's 6%. And this little number here tells me how volatile this stock is. And this is the one standard deviation move that's expected, plus or minus $7.48. So if it goes up $7, it would be at 50. And I could sell the 50, and it's saying, what does this say here? This is probability of in the money. So it's saying you've got a 22% probability of it being in the money, which means you've got a 78% probability that you might get to keep this $1.40 and you wouldn't be called out. Now here you have a 40% probability of being called out, an 85% chance of it coming up and at least touching or kissing it. And if you're called out, you've been paid this 283 to 290 and you get to keep that, but then you'd have sold the stock. If you are assigned or called out, you'll have sold the shares for $45. Now, remember our checklist. We wanted to look for something 1 million shares or more. Well, it's already 11 million, so check. We want something that has open interest as number of contracts on the books, 12,000 here, 6,000 here. And if you're saying, I want to do this as an income generating strategy, now this account has $500,000 in it. So our position sizing rule is we don't want any one position to be more than half of 5%. So that would be $25,000. So we could buy $25,000 worth of this stock. And our max loss per trade is half of 1% or 2,500. Okay. So those are our guidelines for how many shares we could buy. And so if we said, okay, we're going to do this at 45, and then the other question, anybody want to know how much money you could make? So I'm always interested in that. So if we say, okay, if we did this 45, and in Thinkorswim parlance, we call this buying covered stock. So we're both buying shares and we're selling a covered call. Our net expense to get in, because we're being paid for the covered call, is $40.63. And if we're called out, the most we can make is 45. So, and then I'm going to subtract the 40.66. So the most we can make is $4.34. Like that's 10%. Like if I divide that by what I'm spending to get in, $40.64, 10.67%. Okay. So now remember, I don't want to risk more than 2,500. And if I buy 100 shares, this could go to zero, technically speaking. So, I mean, if we bring up this is saying, hey, we could lose up to 4,000. Well, that's not going to float our boat. So what we're going to do is come down here and saying, well, if it continues to trade in this range, it looks like this 39 is a support level. So I'm going to go 3% below that and say, hey, if this comes down to 37.83, I want to exit this position. And when I look at this and say, okay, if I'm paying 40.65 to get in, and if I'm stopped out, if I get out at 37.83, how much am I risking? I'm risking about $2.82 a share. Okay, so 282, if I can risk up to $2,500 divided by $2.82, I could buy 886 shares. Okay, well, 886 shares is going to be a lot more, than the 25,000. So I can, according to my max risk per share, I could buy 886. But if I say, okay, I can buy $25,000 worth of shares, and they have to be in 100 share lots. And so I'm going to divide that by my price to get in, 40.68. So I could buy 600 shares. So if I say, okay, well, I'm going to do my 600 shares. And then if this goes down to 37.83, I want to exit this position. So what I'm going to do is I'm going to come up here and say, I want to create an opposite order. And I'm going to make this a market order because I'm going to be both selling the shares and buying back the calls. And if it goes down to that price, I'm fairly confident that the calls will be worth less, but I don't know exactly what they'll be worth. So I just want to put in an order to say, hey, if this goes down to 37.83, 37.83, get me out. Okay, so if I move this box up, I'm going to hit save. Then when I come to confirm and send, yeah, but John is saying, I think twice, and if you're newer to this, even if you had $1 million account, you might say, I'm just going to do one contract, but practice this in your paper money. Okay. Because this is, not an unreasonable position size, given those are your rules. Now, your rules, you might say, I want to have different rules. Well, make different rules then. But here's how much we could make, $2,610, while honoring our position sizing rules and our exit rules. Now, we could also lose money on this. And, at 600 shares, and call it 3 a share, we could lose 1,800. And in fact, this exit, if it were to gap down, it isn't a guarantee that we get out at exactly that, 37.83 that we've requested. Right. So there's a question saying, can you exit an options contract before expiration? Yes, you can. And thank you for asking that. Okay. So I'm going to send this in. And we're going to add this to our positions. And I'm going to show you 2 example trades. I'll just close these. So one was for IBM. And so here's our SMCI trade. It hasn't quite filled yet. But back on May 13th, we bought 100 shares of IBM. Oops, we bought 100 shares of IBM and we sold the 265 call. And it's now trading at $284. So let's go look at it on the chart. So IBM. So on this day, the market had really been pulling back, IBM along with it. And then it broke out. We call this a diagonal resistance breakout. And again, if you're new, come to the Getting Started with Technical Analysis class. I think that's kind of the IG of where you'd want to begin. And so it broke out and then pulled back and then started to move to the upside. So on this day, we said, hey, you know what? I think this may start uptrending, but my goal is to earn an income. So I met somebody at an in-person event and his goal was to make $100,000 a year with his trading. And this was the strategy he wanted to use, but he didn't know how to put in an exit like I just showed you how to do. And so, let's say that was our goal. So we're not looking to do a long-term buy and hold. We're just looking to make some money in 20 to 50 days and then do it again and do it again. Now, you might not need the money for income. You might just want to grow your account and do it in a shorter term way. But so it came up through our strike and then pulled back again and then kind of went a little sideways and then it took off. So now it's well above that. So if we wait till Friday, if it's still above this 265 level, we would be called out. Now, if we're called out, how much would we be paid per share? Or if it's assigned, it would be $265 a share. Well, if we look at this, we're currently at $264.84. We've made all but a thimbleful. And in total, our return is 4.3%. And we've made over $1,000. And so if we said, you know what, I'd like to just exit this position and take my money, because who knows, maybe some bad news could come out on IBM tomorrow. So I had an exit in place to say, hey, if this went down below 264.75, we wanted to exit, but we are going to, well, that's where it's currently trading. Sorry. What was our original exit? we had said if it went below 241, well, you know what? It's now at 280 something. So we're just going to cancel this order. Okay. So that gets rid of our stop loss order. And we're going to say, you know what? I just want to take the profit. And so how do I do that? I'm going to right click and then create a closing order to both buy back the call and sell the shares for 264.88. And the most we can make is 265. So, you know, we've got all but a thimbleful. And then that frees up our money to maybe do another trade. So that's one where it was kind of like one example of a trade kind of gone right. What about Uber? We're not doing so well on Uber in some respects. So we sold the 95 call, and that call is now worth a penny. A penny. So I'm guessing the stock is not trading above 95. No, it's trading at 85. Yeah, somebody's saying you got a lot of meat off that bone, like pretty much all there was there for the picking. And so this one also expires in 3 days. Okay. And so with Uber, let's go look at that chart. So we bought it on this day, and this was another case of a stock that had been going sideways, and then it broke out, came back, and this old resistance. This is a big, what we call a double bottom pattern. And then it came out, and the old ceiling became the new floor. And we bought it on this day, and we sold this covered call here that expires this Friday. Well, then it pulled back. Well, now we're only 3 days to expiration, and we've made all the money we can out of the call. So we're going to come and look at Uber, and we're going to cancel that order too and say, you know what? We're going to cancel that. And we're going to come back to our monitor and say, we want to buy back this call. Now we paid $90.51. And what we want to do is just buy back these calls for 2 cents, you know? So now that we've bought these calls back, and once that goes through, so there we've got our calls, could we sell another call? Well, we could. We can do whatever we like. So now could we say, hey, we bought it for about 90. How about if we went out to July, and if we want to put this on the chart, we can say, how about if I sold the 90 call for that July, I think it's 21st. And how much would I get? Now, what some traders will do, now we're just getting to meet today, so they might try and wait for it to come up for a few days. But if we came out to our trade tab, could we come out to July and say, hey, they, you know, again, heavily traded over 5 million. We look at the 90 call, 13,000 contracts, tight bid-ask spread. I would like to sell. And how many shares do we have? 200. So we'd like to sell 2 more covered calls. And we're going to sell 2 because we have 200 shares. And we're going to put that in our buy right covered call group. Okay. Now, if you wanted to do another practice, and we don't have time to do that in this class today, but we could look at, you could look at a stock like Celsius Holdings. These sell energy drinks. And we already, you know, we have done this in my trading a smaller account class, where we had this double bottom pattern and it broke out. And I think we rolled our covered call up and out. And so, but could you do a covered call where you're buying shares and maybe selling? It's at 44, sell the 46. And again, this is a stock where volatility is high. Not quite as high as SMCI was, but 56 is high. Like if we compare that to Coca-Cola, it's at 20. And so here's a $70 stock. If you sold the 75, something trading $5 higher, or say $2.50 higher, they'd give you 67 cents. You know, where if we look at SMCI, because the volatility is higher, you sell something $2 higher, you know, on a $40 stock, they give you, you know, 280 or 243. So Ice-T, if you are lost, this is why we record these. And in the beginning, it's a bit like drinking out of a fire hose. So feel free to come back and watch this again and again. So I've got a wrap. I want to thank you for joining me. I think we've covered what we set out to cover. But please hit the like button. It helps move this up in the algorithm so more people can find this content. Subscribe to the channel. Don't forget to follow us in the Land of X. And there was a survey in the chat. So if you could click on that link, and Connie, if you could repost that. Yeah, with the survey in the chat, it's 2 questions. 1, I liked it. 10, I hated it. And then there's everything. Sorry. 1, I hated it. 10, I loved it. And everything in between. 10, I loved it. 1, I hated it, and everything in between. It'll just take you a second to fill it out. Thanks, everyone. Have a great day. We'll see you in a webcast coming up soon. Bye for now.